morning. We're doing about a 40-minute panel on fundraising during tech winter. I have a few questions for our panelists. We're going to start with doing some introductions, and then we'll open it up for some questions from the audience. So to introduce myself, I'm Rishabh. I'm a partner with Jungle Ventures. We're a Southeast Asia and India-focused venture capital firm. We've been around for about 11 years. Our key markets are Indonesia, Vietnam, Singapore, and India. We invest from seed to Series B, C rounds, anywhere from $1 million to about $20 million, generalist fund. Jeff, Joshua, thank you for being here. Maybe we start with some introductions and then I'll jump into some questions.
Thank you, Rishad. My name is Jeff. I'm an accidental VC. I came from the corporate world in digital data tech. My early investments were in Israel and China. So I run two funds, Asia Fund 2, situated in Quest Ventures, and Asia Fund X, situated in MSW Ventures. I look after digital economy, 2.0, 3.0, anything that has data in it. I came from a background of agency world where we invented Cambridge Analytica. So we spy and monitor people and make you buy things on Shopee. We are very good at that. But I've been very glad to see Tech in Asia, 4,000 people registering, and thank you for joining us today.
Thank you.
Yeah, I'm Josh. I'm based in Jakarta. Have been investing in this market since 10 years ago. Currently, I'm representing Vertex. It's a Singapore-based fund. We're backed by primarily Temasek. It's a subsidiary of Temasek, even though it's not 100% Temasek anchored fund, right? So we just closed our fifth fund. It's 541 million for Southeast Asia and India. So we have office in Jakarta, obviously, where I'm based right now. Our HQ is in Singapore, and also we're expanding to Ho Chi Minh City. And also we have office in Bangalore and New Delhi at the same time. So we invest from seed up to Series B, with check size 2 to 8 million US dollars as our sweet spot. We can do lesser or more than that, and we do follow-ons. We have a very, very concentrated portfolio strategy or investment strategy, and our mandate is pretty much agnostic. We can invest starting from agri-tech in Indonesia up to blockchain technology in Singapore. So basically, yeah, that's it.
Thanks, Joshua. Before I jump into some questions, maybe just to get a sense of the audience in the room, a show of hands for how many founders or wannabe founders here? Okay. And investors, angels, VCs? Okay, there's a few. Okay, so mixed bag, but more founders. All right, great. I think that's the focus of the discussion. So let's jump into it. I think the theme of the conversation is fundraising during tech winter. But before we come to the winter, when it was summer and the markets were hot, can you give us a sense of what kind of deal velocity you saw at your firm, and what were the kind of key criteria for deal making? Let's say, 2020 end to 2022 beginning, which was sort of the big bull run. I'd love to hear a little bit about how you looked at deals and what the key criteria were. And then we'll come to the winter.
Okay, so I think, again, back then I was not at Vertex before, so I was in the different fund, but I'm still based in Indonesia and look for deals in Indonesia. What I can say is that, 2020, COVID, and most of the investments made in 2020 up to early 2022 are the effect of the COVID tailwinds, I would say. So a lot of bets back then were made because of the sort of outlook that there are going to be a behavior change because of COVID, right? Mobile working is going to be the next thing. Education will be, there's going to be change in that. Purchase behavior is going to be changing and things like that. And, investors, maybe including ourselves back then, are putting money towards these industries, be it education technology in Indonesia, grocery shoppings, communications technology, e-commerce, logistics, whatever. That is basically the ones that receive the sort of tailwind because of this COVID thing. I think fast forward 3 years later, what happened is that turns out the market is not changing that rapidly, and things are back to, behavior-wise, are back to pre-COVID, meaning that at least in Indonesia, I'm not talking about the rest of Southeast Asia, but at least we can see in Indonesia that people are back, coming back to the office. They are going out to buy their groceries. They are, still going out to hang out with their friends and things like that. So things are back on offline, for example, and then the things that initially we're betting upon, such as the logistics and also the industries such as education technology, people are going back to the schools, like physical interactions, are not eventually that hyped anymore, right? So there's basically that sort of mismatch of expectations, I would say, because of that tailwind. So at the very least, that's what happened, and some of these companies eventually managed to raise a lot of money during 2020 up to 2022. Eventually, the expectations, the factual sort of achievement are not reaching the expectations, and there's going to be a correction in that, I believe. Even it's not happening right now. I mean, there's still, some of them are still having too much money. They're still sort of trying to pivot their businesses and things like that. But I believe there's going to be like small correction at the very least in these sectors. So I think that's the biggest difference.
Thanks, Josh. I think Joshua covered most of the points. At the tail end of COVID, I think everyone was throwing money, just like the governments across the world was trying to save an existential problem, which was the COVID. And everyone wanted viruses, wanted to find a way to cure the virus. Everyone was overspending on masks, buying masks, buying protection and stuff. I think it mirrored, the investment world mirrored that. There was a lot of money, cheap money around. So I used to call that period FOMO fundraising period. So everyone wanted to fix a problem. But in this investment space, the end in sight was very important. At the time, I think a lot of money was thrown without looking at what the end in sight was. It was solving a temporary problem. So I think that caused a lot of valuations to rise, and that caused a lot of what I call team-based investments, where someone was just mirroring something they see in the US, in Israel, in UK, in China, and investments went through. But there were some very good things that happened during that period. I think that period, humans are resilient in many ways. I mean, that's an old adage. People start to digitalize their physical world and physicalize their digital world after that. So they became, prior to COVID, everyone had a digital life that was different from the physical life. But now, during COVID, I think it all came together. You can order fresh food without looking at the food, whether it's a real salmon or not. So I think that the life has intertwined, and I think that has created a different way of looking at things and where VC investments are. So that COVID period, and now I think people are now starting to see now the new normal, which is a bit of a mainstream of commanding a physical and digital life. I think that exists opportunity today. The founders that manage to adapt their businesses to this new world, I think will see a much more better traction and be able to not just take market share, but make a lot of money from the market share. And those people deserve the following checks. And that's where Asia FundX is going after them.
Got it. No, thank you for that. And maybe if we come to, the winter part, and I think you already touched on it, but, in terms of velocity of doing investments and in terms of evaluation criteria, can you talk a little bit about what has changed? I mean, you obviously talked about certain key themes that got a lot of momentum, that got a lot of capital. I guess some of those themes would remain, some would not. But in terms of number of deals you guys are doing in your respective firms, and what is really the evaluation criteria, and how has that changed? Can you comment a little bit on that for us?
I'll start on this one. Go for it. I think this period, the deal making for the VCs, arguably is much easier. We get a lot of momentum coming through, people coming through, but we look at a few things. There's a lot of decisions to be made. In the past, when there's a lot of money and there's a lot of long life, you have time and space. But today, I think many startups don't have time, but the space is still there. So they have to squeeze the time. So we are looking for founders that realize that they have little time left to occupy that space. That was important. We also saw a lot more deliberate actions. Instead of fundraising based on a thesis, there's a lot more deliberate actions taken, more decisions made, and then everyone was just deciding where they want to go to build some momentum. So this has come through. The decks that are coming through right now are all not about potential, it's about reality. So we are sensing also, many people are matching what they see from what they read. So we see more reality, and the conversations are not about market share anymore. Everyone's telling me how much more money they can make from every customer. So there was no need to talk about profitability or CM2, CM3. If you are focusing on making a lot of money for a customer, the profit will come. So that was natural. So I'm sensing a bit more mainstream mindsets and a lot more mature thinkers and away from the old world of valuation multiple. And I don't hear multiple conversations now. My last point was I felt a lot of people were very clear that we're building a capability that a corporate will buy us. So we have capability building for someone. So I thought that was a very mature conversation.
And maybe before I come to Joshua, just a follow-up question, Jeff. Like you invest across markets. You talked about some of the markets you invest in. Are you seeing those factors across? How does Indonesia, how does Southeast Asia, any standout points versus the other markets that you look at?
It is a very good point, Richard. We are sensing that digital is now, I think that we are at a digital transformation 3.0. We talked about it earlier, digital transformation 1 or 2.0. We're at the stage where people understand really that the geography boundaries are not there. And many of the features of the digital data tech world has now become real benefits to people, right? I mean, a lot of my investments in Philippines, in the past when people remit money back home, you get cut off by Western Union or middleman that take some cut. Today, GCash goes straight, you can buy a lechon for your family for a celebration. No leakage is lost. Likewise, many of the economies like Indonesia and Thailand and Malaysia, where traditionally they don't have the infrastructure, today the world is a lot more flatter. So we are sensing a much more bigger understanding of the bigger world. I also saw a lot more emphasis on the four-letter word, which is data, right? I think everyone now has a data farm, and I think what at Asia Fundraising we call it a damn data farm with a lot of API out. So people are looking for first-party data and seeing how they can maximize it. So that thinking actually is very good because it tells me that the founders are focusing on the building blocks of the business that don't just create value, they don't just add value, but they create a lot of new value. I hope I answered the question.
Yeah, thank you. Josh?
Sure. I think the question was how we are, is there any changes in the way we take a look into companies today? I think when Winter came and we worked together with our portfolio companies to, I think, to quote unquote firefight, right? Because a lot of them, or at least many of them, are facing difficulties in these times. I think we kind of learn ourselves in perhaps seeing the company not just from the, I think from the data points, not just from the P&L perspective, but also on the balance sheet and also cash flow perspective, meaning that we are seeing the company not just on the face value, but also until deep rooted to its organs, right? So I think a lot of sectors, for example, like B2B commerce in Indonesia, I believe they have issues not on the sort of performance level, on the P&L level, but more on the operational level, which can only be seen on the balance sheet and cash flow level. So for example, I don't really think any of us pay attention to inventory days or such metrics right before. But nowadays, when after everything that went on with a lot of supply chain companies in Indonesia or agri-tech companies in Indonesia, we are seeing more and more towards that, and we're paying attention to that. So when we're assessing new companies, especially in the similar industries here, we're paying attention to those deep operational metrics as well. I mean, we're not the one doing the operating the company, but we're trying to understand it, and meaning that there's going to be a change in the way we assess or doing our diligence. So for example, before, if we don't necessarily do our sort of mandatory visits to some of their sort of facilities in Indonesia, maybe right now we kind of need to do that, right? So that particular level is definitely changing for us. So that's number one. And number two is, I think when we're assessing the market, before, when markets are great, when it was summer, people are seeing the potential, and a lot of it revolves around how can we increase our potential upside in the future, how can we increase our potential revenue. Right now, when there's no market for these businesses, a lot of them are thinking about how can we save a lot of costs, how can we optimize a lot of things inside of our businesses, right? So I think the things that, if we are, for example, if you're selling B2B, things that are being seen as valuable for these enterprises are shifting. Before, it's more into how can we increase our top line. Now it's more about how can we use technology to not just increase our top line, but to optimize some of our operational sort of capabilities. So that also changes, and I believe it sort of shifted our investment thesis as well. So.
Yeah. No, thanks. That's helpful, Joshua. So, I mean, maybe, a lot of the points that you talked about, the operating metrics, the unit economics, looking at the balance sheets, I think that applies to a lot of growth stage businesses. When you look at seed stage companies, and for a lot of the founders in the room who are potentially looking to raise seed capital today in this climate, right? What are one or two key criteria you would look at, or what are one or 2 points of advice you would like to give to founders for you to underwrite an opportunity right now?
For seed, I think, at least from us, the way we do it is we do more reference check on the founders, definitely, because most of the seed bets are basically founder-driven bets, number one. So, initially we do 2 reference checks. Right now we're doing 4 or 5 per founder, right? And maybe we're not just talking to the founding team, we're talking also with the higher up management level, maybe the employee number 3 or number 4 that they have. So that level of diligence is something that we're doing for our seed deals. And perhaps, this is just my perspective, but I don't really think that if any, I think before, during the summer, you can write a business plan, promises basically, and projections, and someone will write a check for you. Maybe if you are an Ivy League grad or something like that, right? But I think today, I think doesn't work that way anymore. So even if you're a seed level company, I think it's important, number one, to have stake in that company as well. So I think that is something that a lot of investors appreciate more and more today. How much money have you invested into the company? Your own money, right? Be it from your family or whatever, but it's your own money. And number 2 is whether the product that you're trying to create, even though it's MVP, have they managed to create an early traction, early revenue, right? On a smaller scale. Maybe it's not the real business model that is scalable enough in the future. It's not something that they're trying to do that can be optimized in the future, but something that already making money today, right? I think that's, and I'm seeing a lot of more and more seed deals happening right now is leaning toward that way anyway. So seed deals today are, in my opinion, are much more healthier that way. So.
Got it.
Yeah.
That's helpful. Any comments on that?
Yeah, I think seed deals are a lot more well researched these days, right? To Joshua's point, the due diligence today we do are less on the numbers, but more on who are the early investors. So many seed founders today, they come see us, both my funds, but many times of the last 10 seed deals that came, I took 3 of them, but all 3 I used my personal money instead of the fund, because I wasn't sure it was going to be a profitable SME, or was it going to be a VC hockey stick. So that part is a tough one to decide. And to Josh's point on the F&F, right, the friends and family, I think if the family, they put their own money, that's great, they have skin in the game. But more important for me was that they have a few early investors that are from that field that can accelerate their opening up. So they get a lot of, not POCs, they get a lot of PMFs done at one go rather than POC. So that is a nice sign. But he's right, totally. Now we look at the due diligence spent on the seed and the pre-series B deal is exactly the same. It's just the people I talk to are different.
Yeah. No, thanks. That's helpful. We have about 4 or 5 minutes left. I just want to make sure that we can bring the audience in case there's anyone that has a question for any of the panelists. If not, I have a few more. But okay, let me continue. And if you have a question, just raise your hand and I'll bring you in. From a sector's perspective, you talked about, Joshua, a few sectors that got a lot of momentum during COVID. Some of it played out, a lot of it did not. Right now, today's market conditions, any particular sectors you're seeing more deal flow, any particular sectors you're more bullish on than others, given the learnings from the last 2 years?
Personally, and we just did a deal in this actually. So we just closed a deal in SaaS fintech deal in Indonesia. It's a seed deal. So basically, what they're doing is they're building a reconciliation platform for enterprises mostly, because again, for example, if you are MAP or Ismaya in Indonesia, you have like 27, 30 stalls. Each stall have different payment rails, right? Maybe 7 to 8 different payment rails. And when they're opening if companies like Ismaya is building a new branch, for example, they need to hire at the very least 5 to 10 more finance people, right? For them to be able to do the proper reconciliation on a weekly basis, not on a daily basis. Because doing it daily is challenging if you don't have the right technology. So back then, for Ismaya, for MAP, it's not an issue because it was good times, right? Right now, when things are pretty much not going anywhere, where market is stuck, then they need to figure out ways to, rather than we utilize these finance guys to do reconciliation, we might need them to do something more strategic and use technology to finish the reconciliation work, right? So we're investing in these companies essentially. So again, back to the thesis is that we're quite bullish on solutions, enterprise solutions or software solutions that not just bringing additional value to the company, but also optimizing certain things or saving some costs on certain things in the enterprise level, on the client's level, right? Before, these sectors pretty much overlooked in Indonesia. If you ask all the CIOs of big companies, all of them are, how can we increase the revenue towards using this software? Now, it's not the case. And I think as the market is shifting fundamentally, I believe the trend is going to be there like 3-4 more years from now, right? Which is right of our investment horizon. So that's number one. And the other two sectors we're looking for very, very closely. Number 2 is consumer, and consumer has always been like super core for our Indonesian market, and consumption has been the driver for our economy. Consumer brands, D2C brands. We are looking into certain categories in this D2C sort of vertical at the moment. And the third one is basically, we haven't really found the company yet, but there are two, in healthcare, there are two sort of regulatory headwinds basically coming in. Number 1 is in the centralized EMR, and number 2 is on the omnibus law. I think for you who are not coming from Indonesia, this is pretty big for our healthcare sort of ecosystem. So if any of the startup companies are trying to utilize these headwinds, we're more than happy to talk to them, basically, because I believe there's going to be more opportunities coming forward in the healthcare sector because of these two sort of regulatory headwinds coming in. So, yeah.
Thanks, Joshua.
It is a 1-hour question, but I'll do it in 1 minute, right? I think we talked earlier about the digital and physical life as intertwined and merged. So decisions that used to be made physically now can be made digitally, and likewise otherwise. So on the consumer side, I think we are seeing a lot more decisions made on value creation done. So I can see the businesses that actually understand and inspire on people, like the digital media, the influencers, and of course the biggest topic I've been asked the last 2 days, why did President Jay decide to ban TikTok Shop?
Yeah.
All right. I think that has been a great question because he's buying a Rolex watch. George is buying a Rolex watch on TikTok Shop, right? We can part with $20,000 on a TikTok Shop. Today, the mindset is different. Our mindset are different. Please don't rob him later. It's a fake one. Yeah. I'm trying to save for you. Yeah,
it looks real to me, guys. Yeah.
But I think the people are making decisions. So that space is a big thing for me on the consumer side. The decision changing and being value creation. On the enterprise side, we're also seeing what I call the digital transformation 3.0. Agritech has been so shopped around for the last few years. But this region is a lot of agrarian economy moving to an industrial economy. So when we see a epidemic or a pandemic like COVID, many of the fields are now lacking people. So the agri-tech, the digital data tech now are being taken in right now because we need to get on this development to become a development economy. So I'm sensing that across not just Southeast Asia, into India, into now Japan, because now Japan also has not enough young people, or the old people can't do the fields. So we see agri-tech with digital transformation 3.0 on the corporate side. B2B SaaS continues to be a question mark for me. Right? Because I think as you cut the middle layers out and only keep the front office and the back office, Certain businesses, the tough part is getting a customer in. And then after that, the back part is easy. Many businesses today, it's easy to get a customer in, but the back part is tough because keep the customer. So the middle layers are gone. So B2B says those who are in the middle layer will all go in due course. 80% of them will go. But those who are really helping to hold people or get people in that high quality will stay. So I try to do it in 1 minute. In the consumer side, the development economy side, and the B2B side.
No, thanks. That's helpful. I have one follow-up question on the consumer side. I think you both touched upon your openness to still look at consumer opportunities, direct to consumer. In the climate that we live in today, a lot of consumer models require significant capital upfront. I know you're smiling because you saw this question coming, but has your evaluation on consumer businesses changed because you still require significant capital for CAC, right? If you're building a D2C business, probably a year or two, $5 to $7 million, maybe more, to reach meaningful product market fit. Are you willing to underwrite that in today's market? And if yes, what are one or two leading indicators that give you that comfort? Sorry to put you on the spot.
I think it's a great question, Rishabh. Recently, I had a startup come to see me. The startup is Victoria's Secrets for Men.
Nice.
Okay. Yeah, it's Victoria's Secrets for Men. Really good. So I think it's an invisible product that gives you comfort. But I think that don't really apply for most men, but it's all right. But they got great traction, and they had customers all over the world. Now the question was, you had the customers, but are they buying you for the reason you think? Or are they buying you for utilitarian things or other stuff? So that question is tough. When it comes to consumer business, and from my years in the advertising world, the consumer business is consumer mindsets are very flippant. They will show you signs that are buying your products based on what you think they are measuring, but actually it's not. And they will drop you very fast. So the CAC issue is a tough one. The consumer world, it's so tempting to let the digital marketplace, you get customers all over the world. But you must start by deciding which are the key markets. And those accidental sales, you should totally ignore them. So I think that would be the way to go. But I will also add a second point. Some of the consumer business today at the start, you need to get a strategic investor early. Classical old days is you bring only strategic investors at Series C. Now you better get them in early. Perhaps this guy will give me some material that is so nice that after we run from the airport here, it will week off in like 2 minutes. Now I will buy that, right, for the undergarments. So I'll stop there. I think it's early investor come in, early strategic investor come in, and very focused on the consumer market and drop the rest.
Got it.
Yeah, I think for me, and those are good questions and good points. We're doing diligence on exactly your questions, actually. But for us, number one, we look into consumer sector. We look into like the very, very sort of white space subcategory. So I mean, for example, in fashion, for example, there are certain subcategories of these brands, right? So we're trying to find sort of the lead home brand in this subcategory, right? Essentially, we think that if they are the market leader in this subcategory, CAC-wise, it shouldn't be that high, right? So number one, because it's a white space and they are the market leader. Number two is basically, we have some sort of, I think benchmarking to our colleagues in India, we have certain number where we think that if the brand can reach this number of sales, this number of revenue, if it's beyond this level, it's pretty much already done deal. It's a product market fit. It's a defensible sort of brand, or it's a sustaining brand, right? We cannot really tell the number, but we have that sort of particular sort of number or benchmark coming from our friends in India, benchmarking, learning from them. And number three is that on the brand level, basically. Again, the moat is on the brands, and we believe that we need, in our to do our diligence properly, we need to figure out on how we can assess the sort of brand value and how they are going to be perceived by their customers. Essentially, that's basically how we look into this consumer space. Yeah.
Got it.
I think you guys want to ask Rishabh a question?
Yeah.
Ask him. Rishabh, what are the best seed investments you saw this year?
I think for Jungle and our seed strategy, to kind of answer the question I put forward to you guys. I think there's 2 or 3 key criteria that we look at. I think the first one is a deep domain expertise. So what I mean by that is we like to back founders as early as idea, but someone who comes from a domain 10 to 15 years, understands the nuances of the market very well, understands distribution, has built teams, has seen some scale, and so we are comfortable coming in, backing that person at an early stage with a few $1 million to start. I think that's one. The second one is because we are a multi-stage firm, success for us looks like investing across multiple rounds. And so, you know, a very large addressable opportunity, multi-billion-dollar TAM becomes very important for us. And I think the third one, which is really related to the first point, is what we call founder market fit, is just, you know, what is the unique right to win for the founder to build that. I'll end with an example of a seed deal. One example is a women's focused creator economy platform in India and emerging markets called Koto. This is the founding team has worked together for over a decade. The founder CEO is 25 years in media tech, ran a $100 million business prior to this inside a corporate, built it, scaled it, and he left at age, I think 46 or 47 to start this out. And you know, as soon as we met him, we knew the business would pivot a few times from his starting idea, but we knew that this team is going to build something meaningful in a very large addressable opportunity. And some of the key insights that came out on the consumer side, to your point, around why women only, around why using certain technologies to build that, you know, were hard hitting for us. And so we gave them sort of 3 million at idea.
This is amazing share. I mean, the idea of a 46-year-old in a seed founding, I mean, it takes away all the look-alikes that we have seen in the last few years. So thanks for sharing on that. I thought I need to ask that question. Yeah. Can I ask the second follow-up question to him? Does it mean that, yeah, it's all right. Does it mean that spray and pray is gone?
For us, spray and pray was never a thing. I think we have always been very high conviction investors. In our first 3 funds, which were 10 million, 100 million, 240 million, we had 12 to 15 investments despite the fund size increasing significantly. Our 4th fund is significantly larger and maybe the number increases a little bit, but we think that spray and pray at seed stage is really unhealthy for founders. Yes. When you have a large fund in a cap table who's not following on in businesses, there's nothing worse for an entrepreneur to go to market and try to raise capital from other investors when an existing investor who has money is not backing you. So we'd rather do fewer deals, take longer to do them, but when we do them, really back companies at least till post-Series A, almost B, when there's product market fit and sort of the death valley of phase of the company building is past.
Maybe I should be a founder again. Thank you.
I think we're out of time. Thank you so much for a very engaging conversation, and hopefully the audience enjoyed that as well. Thank you.
Thank you.
Give a round of applause.